Okay, looks like we are being live streamed. Just making sure that the volume doesn't show up, and your smile looks great, buddy.
Thanks, man. I'm just ready for the show.
I can tell. Great smile, phenomenal smile. All right.
12:30, I just start smiling.
No, I know. Welcome, everybody, to the JWB Q2 Jacksonville quarterly market update. This is the show of the quarter, everybody. This is our most attended show. This has become a thing. It has become a thing that people gather around, people wait for. It's become a thing that we pour more and more resources into. We got a new surprise, a new wrinkle this time around as far as like the takeaway that you get here, which we'll get to here shortly. But I say we get into it because the people are waiting. I am your host, Pablo Gonzalez, today. And the star of the show is a man that I affectionately like to call GC because he's got genius concepts, knows how to generate cash flow, is a great co-host, and because his name is Greg Cohen, say hello, Greg.
Hello, everybody. Fantastic to be with you.
And we love seeing the community pour in. We normally start with a roll call, but this is one of those shows that's meaty. We got to get through all these topics. So we're going to jump right into it and start describing what we are doing here. This is where the Jacksonville real estate market is in relation to the overall real estate market, in relation to where the world is, in relation to kind of like what are your options and what you should be thinking as a buy and hold rental property investor that GC spends at least 6 weeks thinking about and 4 weeks practicing and 3 weeks doing different versions of it until we get it all right, up until the very last minute. That being said, he's taking data from real life experience, past results, things of the sort. So you should do your own due diligence with these numbers that are happening. This is informational purposes only. We are not a financial advising company. I learned to include that in there.
There you go.
Is there anything else that I need to include into the due diligence piece?
I think you nailed it.
Okay. So that being said, if you like what you hear, and I'm pretty sure you will, your next step is to hop on a call with a team and go through your options individually. This is a macro, micro outlook of what's going on, but it can always be contextualized to your situation with the experts over here at JWB that have received this report for 2 weeks, have been studying it. They know exactly how to apply all this stuff. They know how to talk you through it. So take advantage of this and either call JWB at 904-677-6777, shoot them a text at 904-293-0341, or you can just go to chatwithjwb.com, schedule an appointment, and here is the good news, everybody.
How about this?
We have turned.
How excited are you as a marketer?
Super excited. I'm super excited. We have now figured out a way to get this report done 2 weeks ahead of time, practice it enough to get it all right, and turn it into a publication. So everybody's going to receive a copy, a digital copy by email for coming here of this magazine style publication, kind of like what ULI puts out, kind of like all these other folks that do big stuff like JWB does. We figured this piece out. So you're going to have a nice little take home piece. And yeah, it's going to be great. Rob Joseph said he got an email saying that this was canceled. Definitely not canceled. This is on. This is on.
Nope, we're here.
So that being said, GC, we keep on stepping up and up on like what we are doing here. What's going on?
Well, I'll tell you, I mean, just being here is so cool on a quarterly basis. We get to have this opportunity to share these thoughts. And so every quarter, you and I get to kind of take a pulse of the community. You get to take a pulse of how much we're impacting folks. And I just think, it seems like last quarter, we talked about how crazy the world was and how hard it is to make decisions. Well, it seems like every quarter, the world gets a little crazier.
We're in a crazy world.
We are. But you know what? This community is so special, and this opportunity to share our thoughts is so special for me and for our team. And I'm just so thankful. It's great to see folks are tuning into this call in the numbers that we are, and they're taking action with this call as well. So Pablo mentioned how we're putting more and more resources into this call. I mean, the amount of preparation and the amount of work that our entire team is doing to put this on for you today is so much more than what it was just a year ago, which is fun. And to be able to have this this magazine style report that you all be able to take home, I think will be a nice gift for you all spending the time here.
What's even more than what was a year ago is just the amount, like the percentage of action being taken by our community versus everybody else. You see, you want to tell folks kind of like these like eye-popping numbers we're getting?
So I love when we put some effort into something and you guys are taking it, receiving it, and doing good things in your life with it. I'll share with you guys, over 55% of all of the properties that JWB sells comes from folks who have watched this show in the last 30 days. So you guys are showing up, you're taking this information in, and you're making great decisions that are going to set up future wonderful financial outcomes for you. So when we talk about what goes into this show, we're going to keep pumping more and more into this show because you guys are here, you're absorbing it, and you're doing great things with it.
Not just percentage-wise, but also like there's been a big quarter here at JWB during a time that's been tough to buy rental properties. You want to talk about that? Just like absolute number, not just percentage?
Sure. We're on pace to sell over 400 homes this year, which is wonderful. So a lot of really good decisions are being made in a time when there's a lot of noise out there. And I think this show is one thing that helps cut through the noise.
All right. Got it. So let's buckle in and let's do this, buddy.
Yeah, that's right. Let's buckle in the seatbelts here because the first thing we're going to be talking about is this interest rate roller coaster. This is what we have all been feeling for the last few years. You might not have named it this, but feels a little bit like a roller coaster ride. We loved when the interest rate roller coaster was at its low point. As businesses and as people, it was a lot less costly to do what we wanted to do. And, that was a fun time. However, the other side of this roller coaster is that it goes up to the top. And the problem right now is that it feels like the interest rate roller coaster is stuck just at the top, which is not a great feeling. Yeah, I loved pulling this. I was like, oh, you know what? People have actually felt this before, and I feel like that's what we're all feeling, especially in the real estate community. Not a great feeling, right? When interest rates are this high and it gets this many headlines, right? We need something to help us navigate. We know that it's important to invest, right? We can't just let our money sit underneath a pillow, but in the midst of these high interest rates, many folks are left wondering what to do. And, but what I want to share with you all is we can use our recent past, our recent history to understand the effects of interest rates and understand how to invest in an interest rate environment, which is higher than we all want. So the first thing I'll point out to you all is what happens when interest rates are low. When we were at the low point of that interest rate roller coaster, think back to 2020, 2021. Interest rates were the lowest that we may ever see in our lifetime. Well, at that point, sales of real estate was setting records everywhere, right? It was so easy to sell real estate at that time because interest rates were so low. Well, that's not everybody who wanted to buy a house at that exact moment. What low interest rates do is they pull forward future home sales, and higher home price appreciation is accelerated. And that's definitely what we saw in 2020, 2021. And as long as those low interest rates were there.
Pulling forward demand.
That's right. It pulls forward demand. Now we have to think about what's on the other side of it, the opposite reaction. When we have higher interest rates that are here for a longer period of time than we all want, what that does is it pushes back current home sales. So other home sales that would have normally happened are simply pushed back to the future. They are not eliminated, especially in markets where population is growing. People still need to have a roof over their head, right? So it's not eliminating, it's just pushing back current home sales, which at the end of the day just delays future home price appreciation. It just pushes it back. So the reality here is in Jacksonville, we have had home price increases in 2022, 2023, and in 2024. Home prices have still gone up despite the higher for longer interest rates that we've seen. And I wish this was the narrative that was shared across, the media and in the talking heads. But the reality is the resiliency of real estate markets like Jacksonville, and there's many across the country, is really the story. Who would have thought that interest rates would be this high for this long and home prices still would have gone up for those last 3 years? I don't know, not many people.
Not many people, but you predicted that this would normalize, right? Like when everybody was saying that things would be crashing, you predicted a normalization of these prices, which is what we see here in this chart. Over the long run here, this flattened out, everything got normal and just kind of like stayed steady, right, GC?
That's right. And we were very different than what other people were saying at that time. We've done past quarterly market updates where I outline every single year how people were calling for home prices to crash. And that was definitely what people were saying over the last few years. So you might be wondering, like, how did we know that the home market was going to normalize when everybody else was saying it was going to crash? Well, we use tools like this, and this is one of the beautiful things about this quarterly market update and the report that we're going to share with you is we get to look at the data, we get to look at the tools together, we get to add some perspective from a team who has done this over 20 years, and we draw different conclusions. The chart that you're looking at here is all of the home prices in Jacksonville since 2001.
2001.
Those are the blue lines. And that red line, that smooth line, is the expected median home sales price. So when we're talking about how we expected home prices to normalize, visually what we mean is that we expected home prices to come right about what that expected line would be. And guess what, guys? We are right there right now. Which is really wonderful for our community. You know, obviously we have a big responsibility. We manage over $1.3 billion in real estate assets. So to be able to understand this and share this with you allows you to make really great decisions. It also helps us understand what a not normal or an abnormal market looks like. And I feel like people are so inclined to call whatever happens in real estate the next crash or the next bubble or the next abnormal market. But I can show you what an abnormal market looks like. We can go back to June of 2006, right? When we are talking about a bubble, many people don't know what that means. What they should be talking about is how much higher than the expected price of that market are actual home prices at that time. And so an abnormal market example in 2006, we were 53% above the line in 2006. That was a bubble. And we saw what happened afterwards. Home prices crashed, right? But what we also know is that real estate is cyclical and things come back to this expected trend line. And so what we see is that over the next decade and a half, we've seen home prices appreciate at a rate that has caught up with that trend line. So in 2022, when we were looking at where we thought the market was going, we said normalization. One of the tools was because we looked at this and we saw in January 2022, you know, interest rates were rising and higher at that point. However, we were only 1% above the line. By June, we had risen 15% above the line, but by December, we were only 3% above the line. And it just reinforced this normalization market that we are in. And that's where we continue to be today.
Drew Barnhill, the ringmaster, says in the chat, in my opinion, this is a good time to accumulate as we normalize. Folks who go over their skis thinking that what we had in the last 5 years was normal, recency bias on display, right? Like this is what's normal. It's normal to invest in real estate. It's normal to like follow this trend line here. And we see in these numbers that this is normalized and it's now kind of like teetering like right below this line, which means what, GC?
Well, over time, what we expect is that the values will actually go a little bit above and a little bit below the expected line. So this is very normal. If you're above the line, it doesn't mean that there's going to be a crash. If you're below the line, it doesn't mean that there's going to be a crash. If you're below the line, what that actually means is you will see higher than normal home price appreciation to catch up with the line over some period of time.
There you go. And that's why people come here to the show. They come here to find GC's data and perspective. This is the perspective. Let's get into the current data right now. We're going to jam through this presentation and then we're going to take questions. So the best thing you can do is use the Q&A function. Already got a great one in the Q&A from Not Your Average Guest checking in from the cell phone. That we'll get to a little bit later. But tell us about the snapshot of the data right now.
Well, I always want to give you just an objective look at some of the key measurables for both the sales data and the rent data in the Jacksonville, Florida market. So you'll see that here, our median home sales price is $355,000. But what I really want to draw your attention to is the current home price appreciation rate. Those are parentheses there, Pops. What does parentheses mean?
That means it's negative.
That means it's negative. I know there's going to be a lot of questions about that. So we're going to do a deep dive on just what that means for you and your real estate investments. Outside of that, you know, it looks like a very normal market here. 37 days on market, which is very normal, very much what it was prior to the pandemic. So going back to 2018, 2019 years. 4.6 months of inventory. Again, 6 to 7 is normal. Lower than that would be a market that is going to see higher than normal home price appreciation. And foreclosure rate is less than 1%. If anybody tells you that foreclosures are going to crash the real estate market, you should just exit stage left from that conversation, because that is absolutely not the case. A typical market, a normal healthy market, has about 10% of properties as foreclosures.
10%.
10%. We are less than 1%. So all of that hullabaloo of how we were going to have a large foreclosure crisis from many years ago. You remember that? Yeah, that never came out.
Yeah, I feel like that happens every week. Somebody talks about that. So yeah, so very normal things. Obviously, this like 355 medium home price is something that like 5 years ago, you probably would have fallen out of your chair if you thought that it would get there. We're gonna dive deeper into this 1.4%. That number is not year over year exactly. It's the average of the last 6 months over the average of the last 6 months a year ago, right?
Yeah, that's right. It is year over year numbers, but we want to smooth it out to limit the variations on a month over month basis. So we take the average of the last 6 months looking year over year.
Got you. Median days of market seems really healthy, right? Like a little bit over a month. That sounds like a fair deal to be on market, to be expected. Months of inventory, like you said, historically normalized at 6.5, still below that, which is a good buoyant force. Foreclosure rate is non-relevant because it's not happening a lot, right? So then talk to us about this rent data, GC.
Yeah, so this is a combination of JWB's internal data as well as some market-driven data from our consultants. Our average rent price at JWB is a shade under $1,500 for an average lease. Our current rent price appreciation for the Jacksonville market is just under 1%. Homes rented, occupancy at JWB, rent collection, all extremely high. We're going to dive more into the rent data as well, but renting 870 homes year to date through the month of May is we are setting records here at JWB. Many of you who have had homes that have come up for rent recently have received wonderful news. Our occupancy rate's 98%. Our rent collection rate is almost 99%. So it is a fun time to be accomplishing goals within JWB, especially on the property management side.
Just doing a little bit of quick public math, which always scares me, but like we've been 6 months into this year, 870, that's over like 120 properties per month. That's like 3 properties per day. Like what, 30 properties per? I'm like messing up the math. It's a ton of properties that you guys are renting. Clearly people are moving to this market. Clearly people need a place to live. And good snapshot, GC. So why don't you take us through your 3 market takeaways?
Here we go.
Bring those genius concepts to us.
We're gonna focus on the thing that probably jumps out the most, which is the negative home price appreciation in Jacksonville. So let's dive into this head on together. And any questions you have, I'm gonna be a resource for you. But here's our take. All right. So home prices have declined slightly to start off 2025. But here's the thing: it really doesn't matter for buy and hold investors. For this strategy of buy and hold, it really doesn't matter.
Who does it matter for?
What I would say is it matters. So sure, it matters if you are here to flip properties, if you are an owner occupant and you might need to leave for something, a job or a family change or something, and you need to sell today. Sure, that definitely can matter. But that's not who our audience
That's
is.
not the thesis we all buy.
Right. And the challenge is that those narratives get thrust upon our community or our strategy, and it really is not nearly as important. And when I say it doesn't matter, of course, it always matters. That's why we're talking about it here. But what I'm trying to reinforce with you is it's not nearly as important as you may think. And we're going to talk a little bit about why.
Yeah, I see it kind of like you go to Google Maps and you're trying to find your directions, and there might be like a detour at some point, but you're still on the route to where you're going, right? Like you still got plenty of gas. You're going to get there.
100%.
All right, so cool. So let's talk about what does matter.
Well, I just want to set the stage here for how unique it is for home prices to actually have a decline. And again, we are about halfway through the year, so there's another half of the year things could change. But if this plays out the way it is, this would be very, very unusual. So home prices in Jacksonville, Florida have appreciated 88% of years going back from 1982 all the way to 2024. So to think of this being a year where home values decline would be unusual, and this would be the only year outside of the Great Recession years in the last 40 plus years that this happened. So very, very rare and unique. And when we're looking at just why this happens, we have to understand that a combination of influences, of extenuating circumstances come together in order to deliver negative home price appreciation or price declines. It's not normal. Normal is home prices going up, right? So we have to think about those extenuating circumstances. And you can ask yourself, do we have enough extenuating circumstances in 2025 for home prices to decline for the rest of this year in Jacksonville? My answer is maybe. Maybe. Yeah. I don't know. Yeah. But what I can tell you is that we have to look at the specific extenuating circumstance. Not all extenuating circumstances are created equal, right? We had a lot of extenuating circumstances in the Great Recession that took a long time to unwind. Yeah. We need to be thinking about what is the extenuating circumstance in 2025. What's the extenuating circumstance, Pops?
Higher interest rates, longer than we have like any collective memory of.
100%.
Yeah.
Higher for longer interest rates. Yeah. And we also have to remember what happens when you have high interest rates. Yeah. They push back current home sales. It delays home price appreciation that otherwise would have happened. So the longer that we have high interest rates, the more home price appreciation is delayed, and the stronger home price appreciation will come back when interest rates come down.
I see it as when you have the low interest rates, it's like it extends, like it pulls in demand, like the coil springs out, right? Like when you have these like longer periods of high interest rates, the coil keeps getting tighter and tighter and tighter, which then would make a bigger bounce when it happens. Right?
That's absolutely true.
I have a way with
you do. You understand this coil thing. It's so good.
You got extenuating down. I got coiled down.
Well, I think you're right. Okay. So nobody would have expected these interest rates to be here for this long. And what it's doing is it's pushing back home price appreciation and pushing back home sales. So how do we know this? Well, this is where I get to bring in some data and then sprinkle in some of this perspective here. So I went back to the last time that we had interest rates spike like this. And luckily, we do have data back in the early 80s. And so I wanted to share this with you. This is when sometimes you find data that just supports your thesis so well, and it's just uncanny how close the comparison is that it just puts a big smile on your face as a data nerd. And that's kind of what I found here. So back in 1980 to 1982, we had interest rates spiking. And we also found that U.S. home sales dropped sharply. What do you know? So take a look at some of this data. So in January 1980, our starting interest rate for a 30-year mortgage was 12.9%. 12.9%, by the way. It went way up from there. Yeah. And for all of you who were owning homes in the early 80s, I'm sure you can speak to this, right? We had a max interest rate for 30-year loans at almost 19%. Crazy. Interest rate ended at 16.6% in August of 1982. Well, what do you think happened with home sales when high interest rates were here?
They dropped 32% is my guess.
That's a really good guess. You know the early 80s very well. All right. So from 1982 to 1980 to 1982, I'm getting excited here. We saw a 32% drop in U.S. home sales. Well, history has repeated itself because in 2022, interest rates rose from about 3% to about 7%. And guess what? U.S. home sales dropped 31% from 2021 to 2023.
Uncannily similar numbers. Duration, magnitude of raise, magnitude of drop on sales. Incredible.
History is repeating itself.
Look at you, data.
How about that, right? So then we need to think about what's on the other side of high interest rates. Well, from 1982 to 1984, once the interest rates declined, guess what? U.S. home sales spiked and home price appreciation increased. So from 82 to 83, interest rates went down from 16.6% back down to the really low interest rate of 12.6%.
Steal.
And home sales spiked 38% from 82 to 83.
Barbara Mershon says she thought she hit a gold jackpot in 1984 when she got a 14%.
Yeah, exactly. Yeah. It's all relative, right? It's all relative. Well, it really is. But what is very clear is that interest rates spike home sales or depress home sales, depending if they're high or low. And this also brings home price appreciation back. So we had 4% home price appreciation from 82 to 83. Now, this is across the entire U.S., so it's very hard for you to see incredibly high spikes. But this was 29% more home price appreciation than we saw in the previous year. So 4% home price appreciation. And guess what? Go ahead.
The coil springs.
There you go, the coil springs. And it's spraying even harder and higher the following year. This is interesting because from 83 to 84, interest rates kind of stayed the same, right? It started 12.6, ended at 13.1. So nothing really moved that much as far as interest rates, but home sales continued to increase and home prices gained another 4.8%, which is actually a 20% gain from the previous year. So home price appreciation was delayed and came back stronger.
The power of the tightly wound coil, now springs beyond just the time period of like the first thing, right? Like once it starts going, it really unwinds because it's been bound so tight.
Exactly.
Yeah.
Exactly.
Okay.
So that's what we're seeing here. And that's the answer to why is it a good time to buy in a high interest rate environment? It's because we're simply pushing back home sales right now. And we're pushing back home price appreciation that otherwise would happen, especially in a market like Jacksonville, which has growing population. But if you could go back to 1982, and I don't know what people were saying in 1982, but I would imagine the media was talking about how home sales have fallen off a cliff, and they may have been saying it was a bad time to buy. But if you bought and held single family rental properties in 1982, you would have profited from this handsomely because you would have seen higher home price appreciation in the years, higher than normal home price appreciation in the years that followed. And that's what's likely to happen here as well.
So if I'm an average investor on the street, I don't have this data plus perspective. I'm thinking, interest rates are high, not a good time to buy. Not your average investor sees interest rates are high. They've been high for a long time. The coil is wound real tight. Right now may be a good time to buy because if I get in now, this coil is going to uncoil here at some point soon, we expect. And that's going to lead to this like above average home price appreciation that I get to like take advantage of.
Well, yeah, here's the thing, guys. This is a time to stay the course and follow the plan that you have. And the plan for many of you is to follow your buying plan and continue to add properties according to your goals.
For existing JWB clients who have a plan built for them by the team.
Exactly. I'm kind of speaking to our current clients right now. So this is a time to separate that noise and just simply follow the plan. You came to this asset because of the fundamentals, because of the consistency, and don't let that deviate you from your plan. So many of you have a plan to continue to add rental properties. And what I'm going to tell you here, guys, is we're going to look back 10 years from now, and guess what? We're going to see home price appreciation levels on average over those 10 years being right around 4.8%. It doesn't matter that we have had through 6 months this year a 1% decline in home prices. The more important thing is that you chose this asset class for a reason. You chose to work with a provider who has significant perspective and experience in this asset class. And it's time to just rely on those fundamentals, stay the course, and follow that plan.
And you got a tight coil.
And you got a tight coil.
All right, let's go to takeaway number 2.
Here you go. All right, so that's on the sales side. Let's focus on the rent side. So Jacksonville rents are up about 1% in 2025. But the big takeaway here is that we are poised for significant rent growth in future years. I'm really excited to share this information with you.
Tell us more.
Well, in order to kind of talk about where we're going, we got to do a little recap of how we got here. And really, for the last 2 quarterly market updates, I've shared with you that Jacksonville has been a soft single-family rental market. And but you have to, in order to understand what's happening in the rental space, you have to break it down between single-family rents and multifamily or apartment rents because they are not exactly the same and one can influence the other. What we saw from 2022, 2023 to 2024 is that single family rents were on fire in 2022 and the years before, and they slowed down. What we saw in the multifamily space is that rents were actually really high in 2022, but not only did they slow down in the multifamily space, they declined. Took a dive. Yeah. And that is not normal, okay? So this just reinforces how different supply and demand actually act between 2 asset classes that are very similar.
Why is that, GC? If they're so similar, why is the swing so violent?
So this comes down to the fact that it takes a long time to solve the supply problem for single family homes, and you can solve the supply problem a lot quicker on the multifamily side. Because when you build a multifamily apartment complex, there might be 100 units in that apartment complex. One build might take a year to build it. You just added 100 units onto that into that supply.
Yeah, very different to build 100 single family homes.
Very different.
Very different. Different amount of logistics, different amount of resources.
Exactly. So we are way undersupplied for single family homes. Today, we are.
Yep.
We started off being undersupplied for multifamily homes and apartments back in 2022. However, we are not anymore. We are oversupplied for multifamily.
It's interesting that we were undersupplied for multifamily for a brief period of time. It came back so quickly, and we've been undersupplied for single family homes for like 20 years, and we haven't been able to come back.
Exactly. One of the things that I continue to point out is one of the best things about single family rental properties is the way that you mitigate risk.
Yeah.
And just simply the length of time that it takes to bring 100 single family homes onto the market is one of the ways that protects you and mitigates risk.
Yeah, and these charts kind of like show what you're talking about, right? Like this ability to just really spike really, really quickly in 2021, 2023. Everybody got hot on the market. They rushed into multifamily. And then a couple of years later, multifamily dropped by 75%. Right?
Exactly. Combination that it took a long time for the market to absorb the glut of multifamily homes on the market, as well as interest rates being higher. So when people are making decisions where they want to put their dollars, well, it's a lot more costly to put it into an investment in an apartment complex today than it was because interest rates are higher. So what happened is the Jacksonville market, there was a 75% decrease in the number of starts just for multifamilies, which is wonderful because, the reason why multifamily does affect single family is that you do have a segment of the population that can rent either. Yeah. And so when you have a glut of multifamily, even though single family is different, it can weigh down and anchor down the pricing specifically because of the glut of multifamily properties. And that's what was happening.
I could see like a Venn diagram of like folks that definitely want multifamily, definitely want single family. And then there's somewhere in the middle of that price point, size of family, kind of like space needed that kind of like overlaps. And that one piece could overlap a little bit into single family, but not as much as that drastic thing that we saw in multifamily.
Exactly. We had to clear through that glut of multifamily. And that's really been the story of 2024 and 2025. Well,
seems like there's some good news here on the horizon.
Well, there is. Yeah. The macro stats for the rental market in Jacksonville are very strong for single family, which makes sense because we moved through that glut of multifamily. And so we're looking at occupancy rates. And on the multifamily space, occupancy is improving as well. So again, this is showing that glut is being absorbed. And let's take a minute here to look at median household income. This is Jacksonville's median household income in 2020. It was $66,000. We now have a median income in 2025, $83,100. You were putting the percentages. What was the percentage growth on that? It was like
25% growth in median income in just 4 years.
This is one of the fastest growing median incomes in the entire country, which is wonderful for quality of life. It's wonderful for those of us who live in Jacksonville as rental property investors who are putting your money in this space. This is wonderful for you too, because we need to have the income support rent growth and home price growth over time for you to maximize your return on investment. And that's what we're seeing here in Jacksonville.
Yeah, and that kind of answers this question, right? So there's somebody asking in the Q&A, and we've seen this downward trend in median rent in single family homes. Why is it growth expected in coming years, right? Like we're starting to paint this picture of there was that downward trend. Now this occupancy is back on multifamily. Single family home occupancy is still really, really, really good. And look at the what people can afford here locally, which will drive this competition for housing and things that are looking good here.
Yeah, and I did want to point out that every year rents have gone up in single family. So we have been weighted down by the glut of multifamily. Now that glut is absorbed, but we have continued to see rents grow year over year in Jacksonville, which is very normal. That happens most years here as well.
There you go. So let's just talk about your performance numbers here in this rental growth, or why you think it's such a good future.
Well, and we can kind of look at the macro and why things are changing on the macro side, which we just dove into. Now we have this opportunity because JWB manages over 5,600 homes here. We can take a deep dive into kind of a large micro set, right? It's micro data. It's one company, but Micromax. Yeah. It's coils, Micromax, Venn diagrams, all of that good stuff, right? But so you can look at what's going on for JWB's internal metrics here. And because it is so many homes that we manage,
significant population.
We get a significant population. It helps us feel good about understanding where the market is in overall. Guys, so these are the stats. We have increased our homes rented per month by 72% year over year. I'll tell you, we've been in business for almost 20 years now. It is very hard to grow any segment of our business by 72%. It was easy when we were in business for like 1 year or 2 years. We were like, oh, 72% growth. That sounds fun.
Yeah, you're a
right?
company with like 3 clients. You got one more client, it's a big deal. When you've got like thousands of clients and 6,000 homes, that's a really
hard to do 72% increase.
Yeah.
But that's what the market is delivering, and that's what your team internally here at JWB is making happen. And it is really exciting for our clients. We talked about occupancy growing. We've seen occupancy increase year over year. We've seen rent collection continue to go up year over year. We see lease renewals go up year over year. We see our eviction percentage be very low, and it's the same as what it was in 2024. So when you're seeing the macro look very good, and we understand why that's changing, and you also see this micro max looking very good here, it starts to deliver a lot of confidence for us here at JWB looking into the future, and it should deliver a lot of confidence for you too.
And this goes to the point. So if you checked in from the text, it just says not your average guest. I can't read your name, but somebody put this in the Q&A. May I suggest a point to add to what Greg is mentioning? A factor that does affect is lousy property managers and lousy investors that have put money into properties only because money was free, bragging about how savvy they were investing. Hard to get along with free money for 15 years. JWB has a very strong selling point, not only for the advisory on where to invest, but how to properly manage the said investments. We desperately need thorough, diligent, meticulous, responsible investors and property managers. This is what you guys bring to the picture. It is a reality that the market is highly affected, not only because of the turmoil in the markets, but because this new class of investors and PMs that do not have a clue of what normal conditions are and normal to investing. The way that I put it, as I, move across the property management world and I teach the best practices of JWB as a gold standard, and the more I get to know the property management world, the more golden the standard looks to me, is proprietary data on performance is the number one thing to look for in a property manager, right? Like anybody can show you an Excel spreadsheet. Anybody can promise you these numbers. Can somebody tell you, I did not ChatGPT these numbers. I derived these numbers based on what I've been able to do and things that I'm doing exactly just like you, right? Like these numbers to me is the proof in the pudding of like what leads to a great experience over time as property management to be able to consistently hit this in a market that we previously were calling soft.
That's right. And the cool thing is that I've been with you guys. My whole team has been with you guys for the last 6 months when the data was not so rosy.
Yeah.
When we had to lean in and be with you and say, hey guys, this is a time for this is a soft rental market. This is how we're going to win in a soft rental market. The ability and the accountability that we need to show up with every single quarter and report this data to you, it makes us better. And it makes for a better investment for you. So thank you very much for that comment, by the way.
So as you see, are we still in the soft rental market?
I'm really excited to share with you that for JWB clients, the soft rental market that we talked about for the last 6 months is over.
Nice.
With data like we were just able to share from the macro sense and the micro sense, that soft rental market is over. But I also want to share this with you as well. Our advice on how to win is the same as what it was last quarter. Okay. And the reason is this. There is a lot going on in the world. There is a lot of change in the economy. Unfortunately, there's huge international conflicts. Domestically, there are things that are breaking our hearts, right? Our job is to be a good steward of your money. And we feel that being prudent now and delivering a wonderful client experience is important, and we don't need to rush to just kind of flip a switch on going very, very strong for rent growth right now, right? What we believe is that we are positioned very well for rent growth coming into, call it 2026. But right now, a slow and steady hand, prioritizing occupancy over vacancy is what we have been preaching. We really preach that all the times, but especially over the last 6 months. And that's the message that I want to share with you right now. Our team is continuing to prioritize occupancy over vacancy because we are just now leaving that soft rental market. And this is a time for us to continue to deliver on the gains that you guys have seen over the last 5 years, 10 years, 15 years, and then of course set you up for success as we go into 2026.
Makes sense, right? Like an average investor might see this. It's a soft rental market, time to get greedy. I think not your average investors understand that this is a long game, the number one thing that makes you cut the game short is a bad experience. If you prioritize the experience right now as the going is getting good, then when it's good, you have a really, really good time because you don't come in it with a bunch of baggage and trying to like chase past mistakes or anything like that. So like this idea of maintaining the experience high, betting on this thing, knowing that even better days are coming and like staying in the game, right? That's the name of buy and hold. It's the hold.
100%,
Yeah.
right? You know, our job is to steer the ship. And for clients who have been investing for many, many years, you are playing with the house's money, right? You have seen significant rent price appreciation and home price appreciation, right? And the bigger thing to do is to prepare you to be successful for a full market cycle. And, you know, we never kind of like just jump from one to the next. So we literally are analyzing where the market is right now. This is kind of what I would call tip of the spear information for you, right? I want to share this message. I want you to be excited about it. But part of the reason that you guys show up is to learn where things are going. And we don't necessarily need to take action on rents immediately right now. It is really strong for where we see going forward, but continue to rely on your relationship with your JWB portfolio manager on your specific home. But no other way to say it other than it is really positive, and I'm excited that the soft rental market is over.
I like it, Greg. I like it a lot.
I like it a lot.
Speaking of the tip of the spear, takeaway number 3, GC, give it to us.
Yeah. So, man, I'm so passionate about helping people understand that the best way to win in rental property investing is quite simply doing this model, right? Buying and holding cash flowing rental properties, but doing it next to the next great American downtown. And I've had the opportunity to speak on a few stages recently, and this is a message that nobody else hears. It is something that I think makes all the difference when we're producing a risk-adjusted return on investment, but it's unique. And, you know, I think what you hear, though, is you hear rental property investors talk about this path of progress. And it's one of those terms where I don't know if people really know what they mean by the path of progress, but what I think they mean is that they like this investment. They like investing in a single family rental property, but they're like, you know what? I just want an edge. You know, I want something that's going to give my returns a little juice, you know?
A little juice.
You know, so they think of things like a next great restaurant opening up or a next great shopping center or a road that is going near their investments or a school system that, you know, best friends will become mortal enemies over a house in a certain school system, you know, and ultimately what they're trying to do is to create a little bit of a better return on investment and kind of riding a wave that necessarily they didn't force, you know? So that's really what it means. But if we're thinking like that, guys, the best path of progress runs right through the next great American downtown. And this is something that we have collectively been sharing, ever since I could finally let everybody know what we were doing downtown. It was probably
about 3 years.
2-3 years now. And I continue to do more and more data and research on this. And it's really wonderful because it continues to reinforce and strengthen our position that this is a unique opportunity to be able to invest in single family rental properties. And it's one that will deliver a better risk adjusted return. So some of the new data that I've been able to uncover is that I've looked at a wider span of revitalized downtown cities. And what I've found is that those cities that have had revitalized downtowns have appreciated 89% more than the average U.S. city since 2005.
That number continues to go higher as you expand the data set, is what it feels like, right? Like I feel like we just started talking Denver, Austin, Tampa. Right? Oh, sorry, it was Denver, Austin, Nashville, and Charlotte was like the original data set. Now, as you like expand it further, it looks like it's even more.
Exactly.
Right? And it isn't because there's like all these like outliers. It just looks exactly the same. Like you just keep on stacking them, and these like middle ones continue to like look higher and higher as well. And especially when you compare it to the rest of the U.S. that hasn't gone through this transition.
Exactly right. And the way that I came up with this list is I looked at those cities that had had the highest growing resident populations living downtown. So it's not just pulling the highest, home price appreciation cities. We're starting with which people are moving downtown the most, which is a sign of a revitalizing downtown.
Got it. So just the trend of folks moving downtown when a downtown goes from a 8-hour downtown to a 16-hour downtown, and people don't just show up there to like do their job and leave because they work at a law firm, but they're like choosing to stay there and live and work and play.
Exactly. And the effects are pretty clear. If we start to look at downtowns like Nashville and Austin and Tampa, and you compare it even to where Jacksonville was in 2005, it's crazy to see that the home prices in those markets were lower than Jacksonville and lower than the US average back in 2005. But what a difference a market cycle can make.
Yeah.
Because now Nashville's home prices went from 147,000 to 467,000 in 2024. Nashville is the single highest appreciating market of any major city in the country over that time span. Austin's not far behind. Tampa has seen significant growth. So you ask, what have these three cities had in common? Well, of course, they had revitalizing downtowns that happened in the early 2010s.
And this is my favorite stat that we've learned. This idea that there is a tipping point for when this like snowball of a downtown hits escape velocity and is now going to become an avalanche. And it's this idea of 10,000 residents. And the reason why is that if you study all the great cities in the world, and you study urbanism and all these different things, the key to a great downtown is what we call mixed use, right? It's this idea that you're walking on the street, at the storefront, there's stuff that you can do, businesses you can interact with, cafes, restaurants, shops that you can walk into, and above them, people are living. Any city that you've like walked around, be like, man, this city's cool, has this, right? From Greenville to Madrid, or however you want to look at it this way. And what happens is that when you are developing these cities in the United States, what a developer really needs for this mixed-use building is an anchor tenant. It's that tenant that's going to be like, oh yeah, I'm going to take a big piece of that like commercial square footage downstairs, and that's going to make your numbers work. And what those people look for are 10,000 residents within the urban center. That makes their demand and their retail and their like foot traffic work so they can sell their trinkets and hit their numbers. And that number of 10,000 residents has been something that we've been like really harping on, that opened up my eyes about 4 years ago.
100%. Prior to hitting roughly 10,000 residents, the way that you'll see downtown development generally is through the use of incentives. So cities have to incentivize developers to come in. And while that is effective, that's kind of the state we're in Jacksonville at the moment, that's slow. It's a hard process for the developer, for the city, you know, the community, the residents have to sign off. It's just not popular. And so it's slow. So developers don't really like to go in at that point. But once you get about 10,000 people living in a downtown, what happens is the numbers start to pencil to where a developer can come in and start to develop, and it doesn't need city incentive dollars for the numbers to work. And once that happens, the switch flips very quickly. And that's why downtowns can seemingly turn overnight and the entire skyline can be changed.
Got it. So it's the incentives go away because now the existing demand is there. You don't need to be like, come on, buddy, come on, come over here. Like, people are just like, oh yeah, it's there. I'm going to go get it.
Exactly. Right? Exactly. So, you know, our thoughts are that downtown in Jacksonville today is just like Austin. It's just like Nashville in the early 2010s. Within a matter of years, we saw that home prices, rents, and median income skyrocketed there. And we believe that that's going to happen here in Jacksonville.
All right, you see, I know you like to compare us to these cities that you travel to and you have takes on.
I know. These are all my favorite family vacation destinations as well, which is fun. So I did go to Austin here for spring break with my family. But, you know, more than that, right? I'm able to see trends. We're able to see trends that are identifying you know, significant growth, significant opportunity to invest. If you could go back 20 years ago and buy properties in Austin, you would have been a very smart investor. If you could have bought properties that produce positive cash flow, you didn't have to take on outsized risk and you were able to get some of these gains, you'd have been a very smart investor. Well, in Austin, about 7,600 residents downtown was the start of rapid growth, because after that happened in 2010, the population basically doubled by 2024.
And that's what this looks like. You look from 2012, sparse couple buildings here and there. Here you see a meaty downtown, plenty of density right here in the urban core, and other little pops of density that happen that then get filled in by these other buildings, right?
People don't even remember what Austin was like before. That's how quickly it flips. That was the narrative as I was walking downtown, taking some of these walking tours.
Let's talk about the other city that you've duped your family into going for work reasons.
There we go. We actually haven't been to Nashville yet. Pretty much the only one, but
what's next? Let me guess where you're going for next spring break.
Spring break, let's go. So in Nashville, it was about 7,300 residents was the start of the rapid growth. The success story of downtown Nashville is wide known, and the numbers are even more staggering. So after reaching 7,300 residents living downtown in 2013, the downtown Nashville population grew 174% to now about 20,000 people living in downtown Nashville in 2024.
And this is the visual of that. Again, a couple buildings here and there, to filled in urban core, other corners happening that like look filled, and then everything filling in between. We show this stuff because there is nothing more powerful than a before and after, and living in a before and being conscious of a before, right? Like I've always kind of like thought that it's like everybody can see a before and after picture, but but nobody knows when they're in the before.
Right.
What we are saying right now is that Jacksonville is in the before.
And the numbers support that, right? So Jacksonville has about 7,600 residents, that same kind of magic number there. And our resident population has grown 47% in the last 6 years. And that's before a lot of what I'm going to share with you has actually come online. Our population is expected to grow in a very similar capacity to Nashville. And expected to grow 135% by the year 2030.
It's a big growth, and these are the signs of growth. It's shovels in the ground, it's permits approved, it's all these different things. And if we're going to compare this to these like before and after pictures, right? Like there is a density here that's already happening. And then there is three really, really big projects that we talk a lot about. One is billionaire Shad Khan and what he's doing with this like stadium of the future and the sports and entertainment district, along with these shipyards and a Four Seasons. That's going to be like a big cluster. That's going to be a big density. Then there's the University of Florida, right? Like the number one thing that makes an economic flywheel really go is a world-class institution that can feed talent, that can feed residents into a downtown and into the workplaces. That's going to be like an AI-focused health tech and fintech kind of like accelerator thing. All these other little projects are going to be filling in because now there's also another big mass project that's going to fill it in, which is Gateway Jacks. GC, tell us about it.
Yeah, so Gateway Jacks is the fund and project that JWB started. We started to acquire about 20 city blocks in 2020 and 2021. We were buying as much as we possibly could with nobody knowing about it, which was kind of a fun experience. And so we acquired these 20 city blocks. We then realized that we needed to bring on the talent to be able to deliver on this vision, and we needed to find the money. And so we raised over $230 million in funding for Gateway Jacks. And then we found the talent. We went and we hand selected, found/begged somebody who had done this exact same thing in another city and said, can you please come to Jacksonville? In multiple other cities. They said, can you please come here and deliver this vision for us? That individual is named Brian Mull. He's a wonderful leader. He rebuilt downtown Tampa. He was the number 2 in command for the Water Street project in downtown Tampa, which was a $4 billion project, very similar to what we are doing in downtown Jacksonville. He then went up to Crystal City outside Washington, D.C. and built the Amazon HQ2 headquarters. And so that was a $5 billion project. So somebody who comes from a wealth of knowledge and experience. And the pitch was very simple to Brian. We said, hey, we've got the land. We've got the money. We need you to come. We have an environment that is public-private partnerships work well in Jacksonville. Can you come here and do this?
Another billionaire right down the street doing it that's going to also validate the project. You got the thirst for the people that have been wanting this for a really, really long time, right?
Exactly.
Like, how many city blocks is Pearl Street District? It's like, what is it, like 4 by 5, something like that?
Well, yes. Over time, it's going to be a $2 billion development that's going to span about 25 city blocks.
25 city blocks, right? So this is what Water Street Tampa that I just recently experienced. This like mixed use development that just shows up over these like grid of blocks. It just creates a place where everybody gets to hang out. I just saw it in Tampa. I saw it in Miami, just starting to happen in like 2000. I promise you I'll bring up Miami. 2009, 2010. We all know what's happened then. And again, that's the after. We've experienced the after, but here we get to see the before, knowing that the after was coming. This was the before here, GC.
Yeah, and the cool thing is, now I wanted to share this update with you because for those of you who came to Summit, you got to see that buildings are coming out of the ground right now. Not everybody got to come though. So I wanted to share some before and during project pictures with you, right? This is right next to one of JWB's buildings. This is the first building that we wanted to come out of the ground with as part of the Gateway Jacks project, the Pearl Square project. So that's before. This is what it looks like here pretty recently. We broke ground in October of 2024. This is what it will look like towards the end of this year, next year timeframe. So this is happening right now. This is another parking lot that Gateway Jacks owns, and this is what it will look like. And guys, this is happening right now. We broke ground on our first building in October of last year. We broke ground on our second building about 3 weeks ago.
Yeah, and by the way, this exact streetscape is exactly what I saw in Water Street, Tampa, right? It's like people walking their dogs, attractive people like having al fresco dining on the streets, right? Like somebody like a working out above it. Like everything is one-to-one, kind of like what we've seen. This is another piece right here.
Exactly. We own this parking garage in Gateway Jacks, but it's pretty ugly right now. We're going to make this, we're going to bring all of the elements that make people want to spend time here. So eating, working out, playing, right? We're going to, this is happening this year and next year here at Pearl Square.
These are all the afters right here.
So this is what it will look like. And for those who want to come down to Summit next year, it's going to be even more fun. Every year we get to go and take a look at this because this is going to be such a big catalyst for a better risk-adjusted return on investment for our clients. Here's the aerial of before of what the Gateway Jacks area currently looks like / did look like. And this is what it will look like when fully built out.
And an anonymous attendee is saying, wait, so are you suggesting to invest in downtown projects on 10K downtown cities, GC? You want to clarify that?
I am not. I am not. What I'm sharing with you is the greatest catalyst for the best risk-adjusted returns that you can find. So as you probably know, I believe in following the same beautiful model of investing in single-family rental properties. But what we know is that if you invest in and around the next great American downtown, you can kind of ride that wave of kind of forced equity, forced appreciation that you didn't have to do anything with. And when we know what the next great American downtown will look like, when we see these leading indicators, our message is that you should continue with the same beautiful model of investing in single family rental properties, but just do it around the next great American downtown. So this is a great slide. You know, JWB turnkey properties are all within about 10 miles of downtown Jacksonville. And if you go to Nashville and if you go to Austin, and you look at the home price appreciation that has happened within 10 miles of that downtown and the rent price appreciation, the median income, you now have a way to get better than average returns, outsized gains without taking on more risk. Because if you do go downtown and you start to buy downtown buildings, it is a whole different risk profile and one that most of our clients do not have any appetite for.
Yeah, makes sense. You know, the idea of owning the experience yourself, right? Like going in on one of these like big like $10 million buildings or whatever, you're just part of like a group of people. Whereas like this like perfect level of balance of I get the same upside, I get the same leverage, I get the same exposure to all this stuff, but I own my little house that I can do whatever I want with, and I don't have to like talk a general partner into convincing a whole bunch of limited partners to do a whole bunch of other stuff.
Right.
It just creates another level of control over your own destiny and your own outcome that's unique to this idea that, you know, JWB manages it for you, but it's all yours. It's 100% yours.
100%. It's the same risk mitigated asset. The same control that you have by owning these beautiful single family rental properties. You have that edge now, which is provided by downtown Jacksonville. So that's really what we believe. We think if you could go back to Nashville or Austin in the early 2010s and you could buy this beautiful single family assets that produce positive cash flow each month, you don't have to take a lot of risk. But you could get the home price appreciation and rent price appreciation that they received then. You'd buy as many as you could. You'd be the smartest person in the room because Nashville had the highest home price appreciation since then. Yeah. And at that point, you could get positive cash flow. Today, you can't. Yeah. Right. So that is the opportunity that we see here by investing in Jacksonville, specifically in JWB neighborhoods here in 2025.
I love it, man. So the average investor is thinking, hey, where can I find a house next to like a great school district or shopping center? Then now your average investor is thinking, how can I buy into the next market that's going to be a supernova, like, you know, like Phoenix, where this downtown economic flywheel is going to like affect everything. And you're going to do really, really well over the next 10 years.
Yeah. I mean, I think it's even bigger than that. I think the average investor is probably going to wait until interest rates come down. They're going to wait until home sales go up. And they're going to wait until the media says it's a good time to buy. Yeah. And then and only then will they act. And it'll be too late. You will have received, your returns on investment will be a lot lower than what they could be today, because you'll be late to the game. I think a not your average investor is going to use data and perspective in a different way. And I think the downtown Jacksonville opportunity that I just shared with you, that is just icing on the cake. The model of investing in single family rental properties that is so risk mitigated is what has been tried and true for decades for JWB clients. The interesting thing is that when you buy before interest rates go down, what happens is, and you understand how interest rates going down affects home prices, you actually get to lock in a lower home price today than you'll likely see in the future. You actually get to lock in more cash flow today than you will likely see in the future because home prices will go up. And then interest rates are higher than we all want today, but what do? You just refinance later on in order to get a lower interest rate. So you walk in with significantly better returns on investment by actually doing the contrary of what an average investor would do right now.
Love it, GC. So let's go over the main takeaways. So takeaway number one, Jacksonville home prices declined slightly to start off 2025, but that doesn't matter specifically for buy and hold investors because this is a long journey. And the longer that we have these high interest rates, the tighter the coil gets, and the tighter the coil gets, the bigger the spring. Takeaway number two is that we had declared this soft rental market. That soft rental market is over. We are seeing some really, really nice days ahead for the rental market, but you still want to stay the course right now of prioritizing great experience during an uncertain time in the world. So that sets you up for these like future days to not be catching up to anything or anything like that. And then number three is the tip of all tips, right? Like the idea that Jacksonville downtown is set to make this the next great American downtown. That means super high home price appreciation in comparison to the past. So that is the best investment that you can make. Do you see how to do there?
You did a great job, buddy.
Yeah.
How do you think we did overall?
I think we did overall well, man. So just to me, I am me. I have been buying with JWB. I have a buying plan. I'm just kind of looking around and I'm spooked by the state of the world. What should I be thinking?
This is a time to stick to the fundamentals. You should stick to your plan. Your plan has been built based on your goals. And if your goals dictate that you want to have a different financial outcome, and you have an asset that produces so consistently, and you have a team that can support you, you should follow through on that plan. And for many of our clients, that means adding 1, 2, 3, maybe more rental properties a year. So this is a great time to stick to the plan. If you're a new investor and you haven't chosen a market yet, well, hopefully this helped to kind of bring some insight you didn't maybe necessarily know when thinking about how to choose a market. So if Jacksonville can be that market for you, that you can see better returns without taking on more risk, and that's the big key there.
Or maybe not a new investor, but somebody that has real estate in other markets, and maybe that's like not performing the way that they expected it to, or like they feel like the best days are over in that market. 1031 and getting exposure into the Jacksonville market provides that upside. Right now is a good time to like move that over here as well.
Absolutely.
And then somebody that doesn't have real estate at all, what is the advice for them?
Well, I mean, just do a sanity check for yourself. How are you feeling about where you're investing your dollars right now? We talked about the interest rate roller coaster, right? That's not a roller coaster that we like to be on for real estate, but the real roller coaster for the world right now, and the investments that largely are way affected by what happens internationally, domestically, politically, economically. I mean, that is a real roller coaster. So if you want to get off of that crazy train and get into something that is predictable, that is consistent, that can create wonderful financial outcomes, now is the time to look at rental property investing.
Not just off the crazy train, but into the cool club of JWB turnkey clients, right? Like, let's talk about receipts here.
You know what? This is why we're here. We're here to make an impact together as a group, as our clients and our team. We've delivered over $307 million by following this same beautiful model built on risk mitigation with higher upside. And we have, 3 clients, almost 4 now, that have made $2 million in their portfolio with JWB. We have over 760 clients. You're one of them who have earned over $100,000 in your rental property portfolio. And you didn't start. It's been 3 years or so. 3 years. So this works, and would love to continue to serve the clients who have buying plans with us, help you get to your goals. And if you're not a client yet, we'd love to strike up the conversation and see if we can help.
And you strike up the conversation by calling JWB at 904-677-6777, texting them at 904-293-0341, or scheduling an appointment yourself, self-help, chatwithjwb.com at the best time for your own schedule. Again, everybody's going to get this like fancy schmancy PDF that we've created as like a takeaway that has all the main points in this thing. You can share it with your friends. Forward this to your buddies. Forward this to the people that just don't get it. Send this on, right? This is extremely readable. It's got all this information. Get people in on the secret that us, not your average investors, know. And once they do, invite them to the show.
There we go. Come and hang out.
Have them come hang out. Have them hang out with Tony D and the Ringmaster and the MVP. And who else is in here? Jeff Pettijohn and the Shaman and Michelle John and Barbara Mershon and the Pedro Santorios and everybody else, right? You want to hit some questions, GC, before we get out of here?
Yeah, let's do it.
Let me unshare the screen so it's just your beautiful face. Okay. Not Your Average Guest asks, good afternoon. Apart from the rates impact, which is general in the country, how would you assess the specific impact of what's going on in terms of trade, commerce, disruptions, tariffs, erratic communication, uncertainty, etc., when you have a city like Jacksonville exposed to it by having so much dependence on the port, logistics, this acknowledging that what the government has done has a time lag in terms of seeing potential impact in supply chains?
You know what? If anybody knows how this tariff thing is going to shake out, I would love to know. I mean, I think people around the world we're just waiting to see what effect tariffs have. The push and pull, and do we have tariffs or do we not have tariffs? It's impossible to understand how this is going to affect. But I think when you're deciding which markets you want to invest in, you want to make sure that the job base, the economic base is diverse and that it has a strong foundation. So you look for things like, do you have Fortune 500 companies that are based in your city? Jacksonville has 4 Fortune 500 companies. We do have a large shipping and logistics base, but we also have many other sectors that serve as the foundation for our economic
Fintech,
base.
finance, healthcare,
Military,
military,
right? We have 2 Navy bases here in Jacksonville. So it is a question. The tariffs thing, we're all going to kind of figure out. But, I would think when you're looking at specifically where you want to invest, do your due diligence on all the economy and economic job creators that you have in a market. You're going to find that Jacksonville is very well positioned.
I'd answer that question with one statistic. Median income has risen by 25%. It means that people are coming here for opportunities, and that is going to like float everything despite all this other stuff. 25, imagine having gotten a 25% raise.
Exactly.
Right? Like that's a big deal. Anonymous attendee says, how about the trend of sales and rent? I don't think that's
I think we probably answered that one, right?
We answered that one. The better Greg.
Greg Stone. Good to see you, buddy.
Greg Stone says, is median home price for a specific type of home, like a 3-2 bath? Like when you say median home price, elaborate.
It looks at all homes that were sold. So it's not median home just for a specific 3-2 or a 4-2. It's every home that is sold in Jacksonville on the multiple listing service. And then they take the median.
Got it. Anonymous attendee from France says, how high and long would an interest rate affect negatively the market? I guess we kind of answered that some, right? But like how much higher and how much longer and how much more negative?
The way I look at it is it doesn't really bother me. What happens with interest rates, especially as an owner of rental properties, I own over 400 of them. For me, these things produce positive cash flow. So it really doesn't matter to me, and I'm not looking to sell today. So what's happening with interest rates is it is just delaying future home price appreciation. It's not eliminating it. So it's going to come back stronger and stronger, just like the coil.
It's winding the coil.
It's winding the coil. I don't know how much longer interest rates are going to stay this way. I don't know how much longer would they need to stay to start to see, for home prices to stay declined. I don't know how, but I do know once they start to first significant gains, because you would have seen it the last couple of years that you just didn't see.
Every action has an equal and opposite direction. When you wind a coil, it will unwind.
It's coil expert right here.
I'm a coil expert. Not Your Average Guest asks, do you have any solution for short-term financing, even at higher rates compared to long-term, still at high rates from formal lending institutions that will lock that negative carry for only short terms, typically between a mortgage at 7% with assets deleveraged, returning 6 to 6.5, where you cannot prepay because of unpayable penalties. In other words, short-term financing playing a positive gap where you have a long-term asset financed by short-term debt, foreseeing lower rates in the short term so that no one can refinance later. What a mouthful.
I think what they're trying to do is to take out short-term debt at higher interest rates, with the plan to refinance that into longer-term debt. I think is what we're doing here. What I would say is we have some of the best lending professionals in the entire country as a part of JWB's network. So what I would encourage you to do is to reach out to our team. There you go. You can give us you can set up a time to chat with jwb.com. You can just text us 904-293-0341. Jump on the phone with my team, and we'll either have the answer for you or we'll be one phone call away and happy to help you.
Yep, and MVP Lee with the last question of the day, closing us out. He says, you touched the tip by saying Jax is going to be building more activities for evening to attract more people to the city later than 8-hour work week. This will create more need for tenants to remain in the city to make this city a 24-hour city.
There we go. A 24-hour city would be quite a jump, right? I think once when we can follow the path of Austin, which if you look at Austin's growth, they now count themselves as an 18-hour city.
Yep.
If we can get to that state, whether it's 16 hours or 18 hours or whatever, that will have such a huge impact. Quality of life in Jacksonville will improve dramatically, and you want to be owning assets where quality of life improves dramatically. And as rental property investors, we will be in a very good spot to succeed.
Amen to that. Next week, we are going to show you how you select these properties surrounding these downtowns to build a portfolio. We're going to go back through the portfolio tool, do a new scenario, show you how all this stuff fits in together. From now until then,